I have a 2.875 rate, and my neighbor has, a 2. And it's almost like a badge of honor. It could be they have a VA loan. They could have had a bigger down payment.
Okay.
Their debt to income. It's not just one size fits all. Everything is going to be unique to the person.
This is the spring season. Welcome, welcome. I'm so glad to be back with everybody today. So today I've got a special guest, Michele Hicks from Southeast Mortgage, and we're going to be talking about why that low interest rate may be costing you more by staying than by moving. Welcome, Michele.
Hi, thanks for having me.
Hi, it's so good to have you here.
Thank you so much.
So I want to just know a little bit about you. I want you to kind of tell us a little bit about your background, about, I don't know, what got you into being a mortgage loan originator, and what are the things that kind of get you up in the morning to go face another day and do mortgages for folks?
Yeah, I was always drawn to real estate, so I started after college in real estate doing property management, and segued that into commercial real estate. And then with doing that, I leased to our CEO space for Southeast Mortgage when as they were growing. And then when he went on to get his own building, he talked to me about it, and I was like, I could see myself going onto this side of real estate and helping people with getting the lending side. So I got my license, and so I'm licensed in the state of Georgia to be a licensed mortgage loan originator. And it's I love getting up, and then my first time home buyers, my repeat buyers, my
you
empty
see it all
nesters,
'cause you're front line, right?
Yeah, I see everything, and which is really kind of interesting, and being able to, it's a puzzle. And I love puzzles. And so everybody's circumstance is unique, and to find the best possible way and the most efficient way and the most, especially obviously cost efficient way to help my borrowers and clients get their home. And so, my favorite thing is going to the closing table and being able to see, and be part of their journey, whatever that journey is and wherever they go.
Yeah.
And so I had one when she was getting divorced, and I said, you know what, this is one chapter's closed, but we're about to open another one.
I love that.
And so I said, I can't wait to see the end of the book when you go on and then you start your next one. To me, it's just a really fulfilling job. It is stressful.
And tell us a little bit about, I bet. and so tell us a little bit about what you do as far as, what is your day to day in helping people, as far as the mortgages, and then what does the rest of your team do? So if you could just give us high level rundown, that'd be great.
Well, my job is to basically be the front line. I, as a loan originator, repeat business is my absolute, my biggest compliment, and referrals, and just keeping up with my clients. I work really hard to do yearly reviews with them to make sure they've gotten their homestead or gotten whatever it is they need for that property. Once I get the loan and get it started under contract or refinance, then our team takes it from there. We have a strata, so I have a processor, so then she gets it ready for us to look ship shape for underwriting. So we want the most efficient process we can to make this. It's stressful for everyone. It's it's typically somebody's biggest asset, biggest purchase they're ever going to do. So getting ready for underwriting and having ourselves all crossed and dotted is really important. That's a big part of my day before I put a loan in that's going to be in front of an underwriter, is having all those ducks in a row. Yeah. So that's and it can be, that people have different things going on, and there can be making sure bank statements and things, there's nothing that's going to trip us up. So it's a big puzzle.
And I think that's why I think your role is so important, because people are going to be looking to you first to find out kind of how they can prepare themselves and best prepare themselves. So,
yes.
So that's what I want to get into today, and I really want to talk about these things because I do feel that a lot of what we're talking about today is transitioning out, because folks are going through divorce and people are in these low interest rates, and they are not sure if they should be moving out of these low interest rates. So before we get into that, I want to talk about the emotional side of attachment, right? So, obviously, I find that people oftentimes get married to their rate and they're emotionally attached. They don't want to let it go. So let's talk a little bit about the emotional side and those things that maybe we don't realize we're attached.
Oh, the first thing is I have a 2.875 rate, and my neighbor has a 2. It is like a contest, and it's almost like a badge of honor.
Yeah.
For this is my rate.
So why does my neighbor have a lower rate than me? I'm curious. If we were to just look at that surface level, and you were to take a quick guess,
it could be they have a VA loan.
Okay.
For instance, VA, I think I did one at 2.25. It was just crazy back in those days. They could have had a bigger down payment.
Okay.
Their debt to income can be, it's not just one size fits all. Everything is going to be unique to the person.
Got it.
So somebody else having a rate higher versus lower, their situation, it just lended itself. And at that time, rates go up and down. So depending on the day, somebody can get locked in at a lower rate. The next day, it could go up.
Yes.
So yeah, it's.
Yeah. So we don't know folks' situation, and you're right. It's a contest. If we know that somebody, our neighbor or our sister or brother or anyone we know has a lower rate, we're trying to get that better rate, and we're trying to compete. And I do think that there is something about a lower rate that is attractive.
Yeah.
So if you could just tell us a little bit about what makes it so attractive.
Well, I mean, you're lending on a you're getting X amount, $300,000, and you're only paying 3% versus 4, 5, 6. Go up the scale. It increases your payment. So, but at the end of the day, I mean, I remember back in the 70s and when early 80s when interest rates were around 15, 16%, and people were grateful to have it.
Yeah, that was super high.
Yeah.
There was that time.
Yeah, that was the early 80s.
Yeah.
And historically, rates are 7s. Have been, if you do a historic average, the 7s is right around that 7, low 7s is where we've always been. And right now we're in the 6s. So we're actually lower than the average. The other thing to keep in mind with rates is that on a mortgage, typically a 30-year mortgage, it's not even like half principal, half interest. You're paying almost all interest in the first 5 years, and then the next 5, it's still mostly, you don't get to a break even of half principal and half interest till 15 years. How many people have their same mortgage for 15 years?
Yeah, not a lot.
No. So you're 2.8 and somebody else is 3 or whatever, you're all paying interest, all interest during that whole time, albeit a bit less, but it's in your mind, you're not getting as much principal as you think from that 2.8 to a 6%.
Yeah.
Maybe pennies, dollars, just depending. Yeah. It's not much.
Yeah.
So that's where you have to debunk that go, hey, if you were 15 years in, I'd have a different story to say, and I'd be like, oh yeah, now you're really getting into your principal. But in the first 5 years, you can take a look and you'll see you really didn't get that much equity from paying down your mortgage.
Yeah. I was looking for some stats on that because I read one place, and it was kind of going through the trend of interest rates, and I can't find it right now, but there was a historical analysis done on interest rates since the 1970s and showing how they have gone from, like you mentioned, I mean, there was that one, gap where the interest rates were up to 16% and then they went down and then, of course, post-COVID, they were at like 2-3%,
yes.
Right? What happened during that time, and why did it get so low?
Well, because we would have gone into a Great Depression likely if we hadn't. The thing about when rates go that low and people go, do you think they'll go back low like that again? I pray they don't, because that means we are in some sort of catastrophe. So that was not normal. That was not the norm, although everybody thinks it is, and why they hold on to that interest rate as a badge of honor. That is something that shouldn't have happened. If all things being equal, we'd probably be where we are right now.
Yeah.
If that had never happened and
Got it.
but done it in a very slow, like,
Yeah.
because when we were at about 3.6 or so in 2019, and we had a nice little blip down there a little, right, yeah, about 3.6 by August, I think. And because I remember a client, I was out came out of a refinance, and they go, "Do you think they'll get any lower than this?" And I said, "I don't want to know what would happen for us to go below 3.625, and then COVID hit."
Not
and I
a
called
sign
them.
of a healthy economy.
I called them and I went, "Well."
There you go.
And so anyhow, but if we had been on the same kind of route, I think we would have slowly, that would have never happened if COVID hadn't happened. And then we would have just been on a nice little leisurely rate increase that people, when you take it in little steps like that, it makes it much more palatable. We went from 3%, and then all of a sudden 2 years later or so, we're at 8 almost. So
Yeah.
that's just not normal. And that's what I think all the panic and what causes all that badge of honor. Well, I got in when I got in good. And yeah, you did.
And what happened with the market, with the real estate market, is that buyers knew that they could get those low interest rates, so they all were fighting for the houses that were out there, and it created a inflation of the home values. And
yeah, I lost a lot of sleep during that time.
Yeah.
Because there are no appraisal contingencies. People went above asking. I mean, I had a house and they went $125,000 over asking on a $900,000 house. I mean, that wasn't, I had 150 offers on a house.
Yeah, because they're thinking, well, I've got a low interest rate, so I can afford the monthly payments. I can buy more, I can spend more.
Yes.
But then what happens if we're in this situation now where people are going through divorce, coming out of COVID, and there are more divorces now than ever, right?
Yeah.
And so we're in a situation where if you've got to refinance, are you prepared to refinance that $1.5 million home that you bought for $150K over asking, that you're maybe underwater on the loan?
We've had more low appraisals in this last 2 months, just than ever. They just keep rolling in. I was just talking to my submissions department the other day about it, and they're like, gosh, they're just, more and more underwater appraisals we're seeing. So people need to be prepared for that.
Is it that they're actually leveling out, the home values are going back to what they should have been before COVID?
Things are just like everything, what goes up where it shouldn't have necessarily have been, must come back down. Everything's about balance. So the market's balancing out, which isn't a bad thing. But it is a tough pill to take for someone that you may have a really low interest rate, but there are some chances that you have also lost some value on your home, possibly.
Yeah.
Loss, and I don't say loss, you already knew you were going to do that if you're going in over asking.
Right.
So it's not a loss, it's in my eyes. It's you've got to get to that point where which takes years in equity sometimes to just get up over one of those going over asking.
Right. Okay, so let's say that you need to refinance, you're coming out of a divorce, and most folks have that strong conviction they want to keep the house because they've got that 3% interest rate or 2.9 or whatever it may be. So let's talk about process now. Let's talk about how a person can prepare if they know that they're going to go through a divorce, they know they want to keep the house. What are some of the things that they should be thinking about if they're going to keep the house or prepare themselves?
That they're both on them. For instance, if they're on the mortgage with their spouse and they want to have it come off on their own, or if they want to just have the spouse on their own and then they just want to have the mortgage on their own, you need to talk to a lender.
Yeah.
Because we have the money.
Yeah.
And so don't put the cart before the horse and say, okay, well now I'm getting divorced. And now I'm going to talk to the lender. If you know that's something you are going to unfortunately do, it's not anything. It's no cost to you to pick up the phone and call a lender and go, listen, I need to see where I'm at financially. What can I afford on my own right now?
Gotcha.
And then And then you can go into negotiations or whatever it is and go, look, this is what I can do.
Okay.
And so how do we work that out? Then after the fact.
Yeah.
Because after the fact, now you've got a binding agreement that I got to try and find out a way to shove in a box.
Yep.
And trust me, sometimes it's real difficult. So
Yeah.
if you could come to me from the beginning,
Yeah.
it doesn't cost you anything. It takes.
And what does that look like, I guess, if they were to come to you? What are the questions you would ask them?
Basically, the basic questions that for anyone that's going to be a home buyer is we do an application, do a soft pull. I do a soft pull on your credit so it doesn't show as an inquiry on your credit report,
Okay.
which is also, I know, probably key if you want discretion. The getting your pay stubs, W-2s, your financials, if there's going to be something that I need to see for sourcing for any monies that might happen if you don't have enough equity. Depending on the situation, I may or may not need bank statements. And so, and we have a portal, you upload them in. I can have someone, if they're quick about it, I can do it in hours. And so, but at least you know where you stand. And I can say, oh, look, hey, on your credit, if we need to tweak this a little, while you're going through the process, let's have you work on this. It can help get your score up. So then when you are divorced, then you're in a stronger position because your credit score is higher and you can qualify for more things.
Yeah, and that doesn't cost them anything,
No,
right? That's
nothing.
something that you would do.
Correct.
And so if I'm that person and I'm looking to just kind of test the waters or just understand my financial, ability or, how much I can afford as far as this home on my own. As far as income, what are the key things that folks need to know? What are some, I'm thinking like, oh, I've got my own business. This should be easy. Is that a trick of the mind to think that owning your own business is just easy to qualify, or are there nuances there?
No, there's a challenge there.
Okay.
Usually, because you can, whatever you tell Uncle Sam you make is what you're telling me. So you could make $1.6 million a year, but if you only show $90,000 after you've written everything off on your business, you make $90,000 a year.
Wow.
So that's, So, there's some things I can add in, not many. Depreciation, there's some other things, but it can most definitely, those write-offs are great. You don't tell Uncle Sam about them, but I can't, that's what our guidelines are.
Yeah.
There are some outside the box things that you can do for that, bank statement loans, things they're a little more painful.
Okay, tell us about those.
Well, and here's good news, bad news with it. Yes, the rates are higher, probably 7-8% or so. However, you're welcome. You're not paying Uncle Sam that money, or you're writing it all off.
Yeah.
So if you're writing everything off and you're saving yourself $100,000 from giving to Uncle Sam, just to pay an extra $100 a month for your mortgage. The math works.
Yeah.
So you can't let rate wrap you around the axle, because there are other things in play that you need to think about in your financial house that would offset that, or more than offset that.
I like that, and I don't think most people think of it in that holistically. I think that most of us, when we're trying to, I know when I'm out there and I'm trying to get a buyer qualified, the questions come up, well, my credit is this and my income is that. It's almost like we need to start, like you mentioned, look at the whole financial house and understand. So let's talk about that. What do you mean by looking at the financial house? And let's kind of get into that a little more.
Well, again, that's where people get wrapped around the axle. What's your rate? What's your rate? That's the first question I always get. And I'm like, well, let's back up a little bit and let's take a look at the whole big picture, because where's your money right now? Do you have it in just a regular savings account? Do you have
let's say I've got a savings account and I've got, $20,000.
Yeah. Okay. And then you've got maybe, got a car note. You've got credit card.
I've got a car note and I pay, let's say I have 2 car notes and maybe $1,000 a month.
Yeah. So you've got, all those different things, and we want to look at, all right, so it's not just your mortgage payment, but you also have a car note payment. You have credit card payment.
Yep.
So
credit card payments.
Let's add all that up.
Let's say they're about I'm trying to think of a high number. Let's do a high number. Let's say credit card payments are $700 a month. So.
Yeah. Okay. No, that sounds yeah. I mean, a car note right now, shoot. I mean, $800 or $1,000 a month is what I see a lot of people paying for a car. So we want to look at all your debts and go, okay, well, here's how much your house is going to be and what you can afford based on what these debts are right now.
Okay.
So maybe we can whittle or play with those debts. If it's a refinance, hey, can we go in if you're trying to get the house and via refinance and go, well, if we add in that credit card that you're paying $700 a month on, and at 29% interest.
Oh, for sure.
Yeah, there are 29%.
The credit card rates are outrageous.
They are. So you take that, if you're paying $700 a month, probably means you got about $20,000, $25,000 on that card. You put that into the house at 6%, that's going to be every $5 every $1,000 you borrow is about $5. So that's $125. For that $25,000
Wow.
is $125 more a month for you. Now you've just taken $700 away.
$700 a month to $125.
Yeah. So tell me where that rate, well, don't be afraid of what the rate is that you've gone, or that you hear of us had 3%, because all that matters is your overall financial house.
Yes.
Look at all your payments and everything. How can we make your mortgage payment work the best for you? I mean, your house is an asset.
Yes.
So utilize your asset.
Okay. And I love the way that you're thinking this through. With the house being an asset, we've got that equity, right? And most people, if they have that 2-3% rate, they probably bought it at, right before COVID hit. And so they also maybe, have a good amount of equity. Or even if they don't, most folks are sitting on, if they bought before that time period where the values kind of spiked, everybody benefited from the appreciation after COVID.
Yes.
And so folks have equity that they can use. So could a person in this scenario, right, if my car note is $1,000 a month, could I take some of that equity and pay off my car note?
Yes. Yeah, absolutely. And that's where you want to leverage we want to look here's your car note, it's $1,000. What's your interest rate on it? How many months are left on it?
Right.
You want to kind of look at it from that perspective, so that, because you don't want to put something into your mortgage that, theoretically 30 years is a typical mortgage. Do you hold that mortgage 30 years? No. So most people 5 years.
Yep.
So, but there are the few that do keep, could stay at 10 years. Everybody's different. But, so making sure that we are leveraging what you're financing into your home it makes sense.
Yes.
From an interest rate perspective. If you've got a 2.99% on your car, now if it's keeping you from qualifying, then we're gonna put that into the loan. But if it doesn't and you can handle it, I'd probably say, well, you hold on to that one. I mean, so it's just going to depend on the person. It's going to be case by case, but that's how you look at something, not just the rate. You look at your all your payments together, and let's see how we can make you have the lowest payment and the least amount of interest overall.
Okay. So let's talk about, let me double click on something you said about if it's keeping you from qualifying, we'll put that into the loan. Tell me about that thought process and how that works.
So you'll hear in the process, it's called debt to income. Okay. And so it's how much debt you have to how much your income is. We have ratios that we have, depending on your credit score and the program, that are hard stops if you go over them.
Okay.
So let's just say, for instance, your mortgage with all your minimum monthly mortgage or minimum monthly payments on your car note and any credit card payments, not utilities or anything, can't go over 45%. So just to put in round numbers, so you make a gross of $10,000 a month, then that means that no more than $4,500 a month can go to all those debts.
Right.
So that means your mortgage and all your minimum payments. So if you're at $4,800 for that house, then you're 300 or 48%, then you're over. And we got to find something to whittle down to get you to that 45. And that's where you can go, well, if we pay off one of these credit cards where you're paying $350 a month, and we roll that into the loan, again, realize that every $1,000 is $5 approximately, and now you've taken that $350 payment down to, 40 or 50, and now you can
Amazing.
qualify.
And this is stuff a lot of people don't tell you about.
Yeah, and that's a refinance. Now, purchase is a little different. You have to, maybe we'll fiddle with the down payment. You have a little lower down payment, and I'm going to have you pay that credit card off at closing.
Okay.
Or, we can still finagle things. People don't realize you don't have to do 20% down. There are mortgage insurance companies now. There used to be not many. There's like 6 or 7 of them now that we have that the premiums are really low. And what that mortgage insurance premium does is that as a lender, we're like 20%. We feel confident, if you have to walk away, that means that our mortgage is going to get paid because we know you can pay an agent. We know that you're going to have enough money to move out, let you go start again. So then we go, all right, well, I can't do 20, but I can do 15%. Well, we get a mortgage insurance policy for that extra 5% essentially that you can't come to the table with. And then that is an insurance policy that if something happens,
you'll still get that 5%.
Yeah, that we're covered. So that being said, but you have to pay the premium for it. But it's not going to be much for 5% because that's not much to ask for, and you're already almost there. Then you go to 10%, and we're like, that's still good, but we're going to get that policy. It's going to be a little more than if it were the 5% that you had to put on. And then 5% down, another, where you can still get mortgage insurance down to a first-time home buyer can do 3% down. That's the highest because it's the most risk. But leveraging that mortgage insurance premium because it's so much more inexpensive than it was a few years ago.
Yeah.
People really get scared when they hear that. It's so much less that you can leverage other things by using it.
Right. And that can be eventually kind of refinanced as well, and you can get out of that.
Correct, absolutely. And that's the other good thing. So you're in the house a few years, rates go down, you refinance, and that comes right on off.
Yeah. So let's talk about, a little bit about when somebody has bought a house and they're in this post-COVID situation. Do you all offer any incentives right now that can tell these people, hey, we have programs for first-time home buyers. We've got programs. We've got different incentives for sellers because they're sitting on this house and they don't want to sell it, or even just incentives to get more buyers to come.
Oh yeah, no, we have well from the seller's perspective with my agents. We can come up with a program, and you can say, hey, I know that my seller wants to put this house on the market for X amount of dollars, but in this market, we know if it's going to sit a while, we're going to take it down $20,000 in 2 weeks.
Yeah, we've got tons of houses. Right now, houses are moving very slowly. So this is an economy where houses on the market, they're sitting on average about, from anywhere between 60 to 90 to even up to 100 plus days, right? So what are the incentives that Southeast Mortgage that you would offer if I give you a call and I'm a seller and I'm like, I can't sell my home, I've got an agent, do you have anything that we can offer, and I don't want to drop my home price?
Yeah, no, I do. This is actually a really interesting way to use that $20,000 that you would normally take the house price down. Again, I always go back to, for my buyer, whoever's going to come buy your house, you lower it $20,000, then $5 for every $1,000, right? So that's $50 for $10,000. It's $100. So it lowers their payment $100. That's great. But if I could take that $20,000, you keep your list price.
Okay.
Take that $20,000 and I buy down the rate to and I'm just throwing this out. I don't know, what rates are, but you could go from 6.25 to 4.875, and now I've just saved your buyer $350+ a month.
Wow!
Because I've lowered the rate to a 4. And doesn't a 4.8 sound wonderful to say?
Absolutely.
That you can put on your listing and go at my preferred lender for a 4.875 rate, and it's a great tool for that. And now you've just taken someone. Let's say that house was a $500,000 house, and now someone that's at a $400,000 price point can go up to a $500,000 price point. So your house is going to look a lot nicer to someone who's been looking at $400,000 houses, Now they're looking at a 500, they're going to go, oh my gosh, and I can afford it.
That's great.
So you
That's
open
great.
up a whole new arena to more buyers.
Okay.
Your neighbors are happy because you sold at list price, so you keep the value of the neighborhood up.
Yes.
You're happy as an agent because you got list price, and you can get more business by saying, look, I can sell
Right.
your house list price.
Right.
So
I'm not dropping the neighborhood value by
Yeah.
dropping the price,
Right.
you know, for
And-
other competitive
Yeah.
prices. And that sounds like a win-win for everyone.
It is. It totally is. So
Yeah.
I don't know, it's just a.
So what about the seller? So where is that, because you're dropping the rate, right? So where is the 20,000 coming from?
It would come from it would come from the seller. So instead
Okay.
of you dropping the price, we would already have it
That
basically.
20,000 concession
Yeah.
would go to the lender,
Yeah, well, it would go to the buyer, whoever buys your
to the
house.
buyer as the rate drops.
that we would
Right.
use as a buying down the rate.
Right. Mhm.
And so that, we do flyers. We can do, we have a whole
Yeah.
client services group that will make sure it's all in compliance and that it's set
And
up properly.
20,000 over the life of a loan, a monthly discount on your mortgage
350.
payment is way better
Oh.
than, you know, assistance at closing with your closing costs.
Yeah, yeah.
I mean, to me, that's more attractive, because if I'm asking for a one-time closing cost fee, you know, that's helpful. But what's really going to help is
Yep.
over time getting that help with your monthly payment.
Well, if you can it helps you qualify, then
Absolutely.
that's the, versus not qualifying for it. And just having a
Absolutely.
bigger pool of buyers that can buy your house, because
Yes.
you've brought your house, what they can afford, you've brought their affordability and their buying power up.
Yes.
That's worth its weight in gold.
Amazing. Perfect. I'm really glad that these programs are out there. And okay, I want to switch and pivot a little bit and talk about home equity loans. I've always wondered, we know that people use their equity to kind of, to help them to, purchase second houses, or if they're divorcing couples, maybe they want to purchase a second house that one of the couples can move into. So what's the difference between, I guess, a HELOC and a refinance or a cash out?
So a HELOC, I like to think of it as like a credit card attached to your house.
Okay.
So let's say you're got a HELOC and it's for $100,000. Then you're not going to pay, you're only going to pay for what you use. So if you take $50,000 out on it, you're only paying for $50,000. It's typically an interest only, and it's going to be probably between 7 to 8%.
Okay.
Or 9, 10. It depends on your credit. I just did one at just shy of 10% for someone in the mid 600s credit or 680 credit scores. So
Got it.
it's very credit score driven.
Okay.
So if you got 800 credit score, you're going to get in the 7s. So it is a higher interest rate than a cash out
Regular.
refi, but you have flexibility with it. Versus a cash out refi, I'm going to give you that. You're going to leave the table. You're going to get $100,000. You're going to check for $100,000. So, but you have a lower interest rate. So it really depends on what you're using with that, what you're using that money for. So, for instance, if you wanted to get an investment property with that, then you might want to consider a cash out refi, just because you're going to get a lower interest rate overall, and you might have some tax. I'd have to talk to an accountant, but there might be some tax advantages to it. There would be with the HELOC as well, but it's just going to depend on the person. Both are fine. For the HELOC, a lot of people like them because then they keep their 2.875 mortgage. And then they just get that piggybacking on with them. So,
Yeah.
but if you're just looking to maybe remodel your bathroom or something, and it's got to make sense. So it's got to be a big enough amount to do a cash out refi for. So like, for instance, if you wanted $200,000 versus you were just doing a $50,000 renovation,
Yeah.
then a cash out refi is a no-brainer. If you want that much money, but. I think I think that, the HELOCs have their place. And I find that most people right around that 50,000 range would make, sense to do a HELOC.
And most folks are not. Well, you wouldn't think that they would keep it that long, or usually you pay it off in 5 years or, want to pay it off in.
No, they never do. Oh, no. And that's the bad thing about them is because you're paying interest only, so you're never hitting the principal.
Yeah.
So you're really just never, whereas at least with a cash out refi, you're always paying some, getting some principal back.
Got it. So that's the real cost of pulling that, using a HELOC, right? You're paying that interest only.
Most people don't think about it. They just see the payment and just make the minimum payment, not remembering that likely it's an interest only loan.
And that payment can change too, right? It can.
If rates go up, then that payment's going to go. Yes, it is not fixed.
Yeah.
So at least with a cash out refi, you know what you got.
Yeah, that's good to know. Okay, and then I want to read an article. This is, one of the articles of interest that I usually follow. It's from one of the attorneys, who are dedicated to family law. This is some information from the U.S. Census Bureau, but it talks about like the high interest rates and how today's interest rates are making it more expensive for people who want to, stay or do a buyout. And we'll talk about buyouts later. But it talks about how on a single income, the cost to downsize and is the home ownership rate for divorced individuals is at 49% compared to 78% for married couples. And so, and it's even harder for folks who want to, who are one person income, to qualify. And so that 3% change of rate, so if you're refinancing, say, a $400,000 mortgage, at a 3% rate, that monthly payment is around $1,700. But it talks about with rates now above 6%, currently a 30-year fixed rate mortgage, that same refinance loan could cost over $2,400 per month. So that's a difference of $700 per month. And so that rate change, makes it more expensive. So the dilemma is, and then of course you've got rental properties that are expensive too. So the cost of rental homes has gone up as well.
Yeah.
So folks are talking about the challenges that folks are having with keeping the family home. And this is very interesting because when I read this portion, it says, while uncommon, selling the marital home, it says 44% of homeowners age 50 to 64 still have an outstanding mortgage balance. And then it talks about how those there's a rising divorce rate amongst the elderly community of people.
Yes,
so
I'm seeing more of that.
I do want to kind of talk a little bit about that. What are some of the things that you're finding? Because this divorce rate seems to be going up. It quotes here, and this is from the Divorce Lending Association's article. It says the CDC's divorce rate of 2.4 per 1,000 people translates to 830,400 divorces per year. An estimated 65 to 70% involve real property. So 65 to 70% of the population, 2.4 people for each 1,000 people are getting divorced. And it says that those age 65 and older, this rate has tripled.
Oh yeah, it absolutely has. I've
so what's going on with this the 60 and up group?
I've heard, if you can think it, I've heard it, and
and this is post-COVID, so they're saying that this is they're calling this gray divorce.
Gray divorce. Yep.
And these are folks who are 50 and up, and so it's just stating that over the years since 1990, the divorce rate for this group has doubled, and then those 65 and older, it has tripled, and then by 2013, this percentage is expected to increase further.
Well, I mean, we're living longer. And we have things that we know to do to take care of our bodies, to be around longer. So, you know, I think that's part of it. I mean,
Yeah.
50 years ago, everybody smoked and
Yeah.
not to sound, but I mean, you know, the longevity wasn't there. So people are living longer
makes
and,
sense.
you know, I mean, so not that, you know, I mean, not to sound, I mean, I'm married. I don't ever want to, you know,
Yeah.
with my husband, but, you know, I guess that people didn't think they were going to be around for an extra 50 years. I don't know.
They're like, oh, I've got to deal with this person another 20 years. I'm feeling great right now. I'm hitting that. So, you know, as far as like, you know, them coming to you and needing to, you know, qualify at, you know, 50 and 60 years
Yeah.
of age, that's got to be tricky.
Yeah, or 70. Yeah, that is 70. And I mean, and a lot of times the mom's a stay-at-home mom or never worked.
Yeah.
So, you know, I've run into, you know, the situations where, you know, that when you're getting into retirement income and they're not working, then it's fixed income. So I can get hamstrung a bit by that since they don't have a job anymore.
Yeah.
That it's, you know, we have to then look at assets and work off of those type of things. So there's some challenges with that age group that I don't typically run into with a younger age group where they're both working.
Yeah, that makes sense.
So
So do you count retirement income, 401k?
I do.
Social
I do.
Security, all
Yeah,
that?
I count.
Okay.
Social Security is what it is. 401k, just depending on, not to get into the minutia of it. In the best case, I can take whatever they have in their 401k and I'd say divide that by 240 months because that's, you know, and that's just the it's
Gotcha.
360 if it's Fannie Mae. But anyhow, and then so it could come out to say, all right, I can give you another $3,000 a month because I know in your 401k you can take that out over
Yeah. 240
months, and that's basically
Gotcha.
got me covered for what I can count as income.
Is there a low rate for elderly?
We don't.
Okay.
Rates are not by age.
Okay.
So
that is discrimination.
Yeah,
in a
you
way.
can't. Yeah, I guess that would be. Yeah, but we do not. Yeah, we do not have rates based on age.
Yeah.
So, but
And I bet they would love that. I mean, senior folks would love a lower rate.
yeah. Well,
you know,
there's something called a
discount.
reverse mortgage, but that's a whole different beast. That you know, that
Yeah.
in certain circumstances, you know, they may make sense in a divorce situation. I don't know where you know, I'm sure it has its place. But, you know, I mean, sometimes it's a really good time for them to make a clean break. I mean, I had one lady, and so she wanted to be in a 55 and better community to meet with people and start a new life. And so
Yeah, which is
and
what
it
I
was
would
small.
think most
Yeah.
folks at that age would want to.
Yeah, and so she
Yeah.
took part of her money, 50% down, so it made it a reasonable mortgage for her. And so, you know, there's certain things that, you know, you think you give and take. Sometimes the house is just too big. I mean, the
Yeah,
kids are gone, you know.
For
and
sure, that's the time to downsize.
yeah, she was like, you know, I think I'm okay with going to a nice, it was 3-2
They're really
ranch.
nice out
They're
here.
nice. It was
Yeah.
really nice.
They're luxury and
yeah, and they had a pool and well, pickleball, and a clubhouse with all sorts of
community
events.
people around you.
Yeah, she
who
loves
have
it.
Events.
Yeah,
Yes.
she's having a great time. So, I mean, sometimes those kind of pains are hard, but you know, you look back at it, and you know, none of us would have children if it were, you know, if you remember the pain at childbirth. You know, I'm never going to have to do that again, and they're on second child. So it's the same thing with a house. Sometimes, you know, it's a roof over your head, and it keeps you safe and warm, and they're beautiful memories.
Yes.
But sometimes there's just a time to say, let it go and go, my lifestyle is such that I need something else. Don't let your lifestyle be married to a home. Let you enjoy your lifestyle. Go, you know, if you wanted to travel, now you've got, you know, downsize, give yourself a little extra money to go do the things you want to do. Really start your life over.
I love that. Well, this is Michele Hicks, everyone, and she's with Southeast Mortgage, and I'm MaryJ, divorce realtor. If you're staying in a home right now and you feel that you maybe have outgrown it, or maybe you just want to downsize and make a new transition out, think to yourself, am I staying because it's smart, or am I staying because I'm scared? we're going to look at the next episode and we'll talk about refinancing and buyouts. So stay tuned, and thank you for being here. Thank you, Michele Hicks.
Thank you.
It's been a pleasure.
It was wonderful to be here. Thank you.
You're welcome. Okay, see you all next time. And if you have not already, please hit the subscribe button. This is MaryJ UNCoupled on YouTube. So please like and subscribe and leave your comments in the comments section.